Welcome back to another video, fellow Baba bag holders. So I think the nature of this video will be slightly different. I just wanted to take the time to really sit down, reflect, and to more importantly, share some of the lessons that I've taken away from my entire Alibaba journey thus far. So it's 10 cold hard lessons that I've taken away from Alibaba. So of course, before we begin, remember to help smash that like button. You won't regret it. Unlike the many other regrets that I'll be explaining or expounding throughout this video. So you should check out courses on specifically science and math over at Brilliant. So Brilliant not only help you brush up on the basics, but also leads you through university level concepts like infinity, the history of math, and even introduction to probability. So I think having a foundational understanding in probability is critical in investing because we have to work with too many assumptions. So it's not just math. There's interactive courses on physics, computer science, and a whole host of a different variety of STEM topics as well. So it will probably help you become a better thinker. So finish off the year by upgrading yourself with Brilliant, where you'll find thousands of courses with exclusive new content added monthly. So to get started for free, visit my link in the description below at brilliant.org/taygking. And the first 200 of you will get 20% off Brilliant annual premium subscription. Thank you Brilliant for sponsoring this video. Now, I think the first most important lesson is really this idea of never underestimating the markets. And more importantly, this entire theory behind animal spirits. So for those of you who don't really know what does the animal spirits of the markets entail, essentially there are your two main ones, which is your bullish spirit and your bearish spirit. So in this case, there are many instances where in a very bad market, when the economy looks bleak, when people are losing their jobs, mortgages are being defaulted on, that's when you see a bear market will continue sliding further into an even worse bear market. And in this case, in many of these Chinese tech names, we are talking about huge conglomerates here, by the way. We talk about Alibaba, Tencent, Meituan, JD, Pinduoduo, the list goes on. Most of them had their valuations cut by more than 80%, or at least more than 70%. Some are closer to 80%, some are even went down to 90%. And these are hundreds of billions of dollars in market cap. So they're not your mom and pop shop, they're not your Luckin Coffee, etc., etc. So they're essentially not laden with fraud. They're your biggest tech companies in China today, but I guess the market just doesn't like them. That's why they sold them down to incredible valuations. I think the funny thing is, at least in this Chinese tech episode, in any single bear thesis of Chinese tech companies, valuations will never be a problem. Because for avid investors, we tend to pay close attention to valuations. But in this case, for many of these Chinese tech names, valuations are never the bear thesis. The bear thesis is always about some other thing. Today will be about geopolitics, tomorrow it will be Taiwan, the day after will be lockdowns, and yada yada yada. You get the point. So which brings me to point number 2, or lesson number 2. When things look dark, don't forget, there's still pitch black. So this lesson was deeply etched in my mind, because at one point in time where I wanted to average down, I realized that, hey, I've bought in a little bit too aggressively too early on. And I did not have enough bandwidth or capacity to continue buying down even more aggressively when it was trading at crazy valuations. So after the party congress, all hell broke loose. Everyone was just on a fire sale. It was down 10-15% across the board. And that was when I knew that I kind of screwed up somewhere. My system doesn't seem to be as foolproof as I thought initially, and there was a lot of refinement that needs to take place post this entire Chinese tech episode. But I think I just wanted to kind of quote-unquote defend myself the other time when I first transited into buying to Chinese tech. So I started a really small position at the end of 2020 because I understood that there was actually a collapse in valuation already. It was around 20 to 25% then, where Alibaba was trading at a peak of around $300 odd. So in my first entry, Alibaba was actually down 20%, if I'm not wrong, give or take. And then it was a starter position, so it was a really small position. I think it was less than $1,000. And thereafter, let's not forget in 2021, the US market actually experienced a humongous bull run. So I think the S&P 500 ended with a double-digit gain. And it was also in that same period where Chinese tech just continues crashing down. And by continuous crashing down, I mean really crashing down. So many of these big names like Alibaba, Tencent, Meituan, Xiaomi, Jingdong, Pinduoduo, all of them across the board are all down in 2021. And that was also that period when you see, a lot of investors on the sidelines saying that, hey, China stocks in particular are uninvestable. But all I have to say is this, and I was under the impression that, hey, since we are in a world where easy money was essentially flooding the entire market, I was thinking at the back of my mind, many of these valuations cannot be dirt cheap, right? Because there is still so much money swishing and swashing in the entire economy. And when cryptocurrencies can be trading at sky-high valuations, I don't understand why Chinese stocks can't. And evidently, I was proven time and time again that I was so extremely wrong. So just be extremely critical in some of your fundamental assumptions when you are viewing at the market from a macro lens. But that said, to circle back to lesson 2, when things look dark, don't forget, there's still pitch black. And the main important lesson that I've taken away here is that it's always healthy to have some level of cash being deployed somewhere, whether is it in fixed income, in bonds, or something that actually retains its value when we are experiencing a bear market. Because honestly, you won't know what kind of opportunities Mr. Market will throw at your face at any point in time. So moving on to lesson number 3. Investing actually revolves around the 2 C's: capital and courage. So you either don't have the money or you don't have the balls. And I think you'll only truly know yourself when your portfolio has experienced a drawdown of more than 50%. And I can tell you, I touch my heart now and I go back, if I can time travel back again, right after the party congress on that Monday, when Alibaba was trading at sub 60 or 61, $62, my courage was being threatened. So lesson number 4, it's this idea called the endowment effect. So the endowment effect is essentially an emotional bias that causes investors to value an owned object higher, often irrationally. So looking back, I definitely fell victim to this cognitive bias. If you haven't been following me, I think you should know that I'm a huge Alibaba bull. And I think by making my position so publicly, and even my real life friends are kind of keeping me accountable to many of my positions that I pick. Surprise, surprise, I didn't only pick Alibaba. I picked companies like Tencent, Meta, TSMC, etc., etc. And when the market was going down, it essentially challenged my identity because I was basically being framed as the clown that picked all the stocks, and I even had this name called Tay Falling Knife Cheeking, where Falling Knife is my middle name. Because whatever stocks that I touch, it essentially goes down the following few months or following few quarters. And when I'm backed up to that position, I'm always in the position where I'm trying to defend my picks, saying that how good Alibaba is. Alibaba is the biggest e-commerce company. Without Alibaba, without Tencent, China is going to fail, etc., etc., etc. And after telling yourself so many good stuff about the companies that you pick over an extended period of time, I think humans are capable of self-hypnotizing. And I was kind of dragged into this entire ideology that, the market is irrational, my picks are the best, and I tend to overvalue the companies compared to before I even owned them. So I think from that front, I gained a lot more new perspective. Even though we all like to believe that we are objective, but deep down, we know that we are all kind of emotionally biased to a certain extent. Which brings me to lesson number 5. Always try to build a check and balance mechanism in your life. So as we understand, we love governments to have check and balances. And I think so do our lives. Because I believe that we tend to hang out with people that think like us and act like us. So I don't care whether is it your wife, your girlfriend, your friend, your parent, whoever. Preferably someone that you actually respect and you listen to. And that person basically has to show some tough love when it's needed. But more importantly, I don't think it's necessary that every time the person steps in, you have to take a different position. But more so to build this kind of feedback loop in your life so that you are constantly being reminded of your different cognitive biases, where your blind spots are, etc., etc. Now, moving on to lesson number 6. I think that managing risk is even more important in quote-unquote distress investing. And personally, I think I would define investing into Chinese tech, this entire episode, as a level of distress investing. So if you were to look back this past 2 years, whatever that has transpired for the entire Chinese tech sector, You can see that there were many forces at play here. Firstly, the government was taking a much more active approach, looking into regulations, looking into anti-competitions, and essentially the foundation of the entire business environment was experiencing tectonic shifts. So I don't care whether the tectonic shifts are for the better or for the worse for the company. As long as there are tectonic shifts, that means that there's a great deal of uncertainty. And you can see that the market was essentially just reacting to this uncertainty. Secondly, if you were to really take an objective approach to really identify the issue here, many of these tech stocks was operating in a very bad environment, mainly speaking about the weakening Chinese economy. And although we know that all these are short-term in nature, we can't lie that they are experiencing some sort of turmoil and headwind in the short term. And you can't really blame the market for reacting in how they've reacted thus far. And more importantly, I think when you are engaged in this sort of distress investing, you might want to pace yourself out even more, take a much slower approach, and to really see how things go and see how things transpire. And don't be too eager or too enthusiastic to just dive head in, thinking that, oh, it's a short-term problem, they will fix itself, and you'll come back a better man. I think those assumptions are true. I mean, even true until today. If not, I wouldn't continue holding on to Alibaba stock. But I think the key part here is you can keep telling yourself that, hey, all these are short-term headwinds. The Chinese lockdown is a short-term headwind. The government or the weakening economy is a short-term headwind. The property crisis is a short-term headwind. The consumer confidence at an all-time low is also a short-term headwind. I think we all know that these are short-term headwinds. But it doesn't mean that the stock won't go lower. Since you are actively engaging in this sort of distress investing, you might want to consider being more diversified in your approach rather than just basically putting all eggs in one basket. So even a 10 to 15% allocation is probably enough to try to time the market and to ride up the recovery. But on a personal note, as I attempt to defend myself, I would believe that my portfolio on an absolute level, it's considerably much lower compared to many of you out there who are running 6 figures, 7 figures portfolio. So that was why I kind of concentrated into many of my positions. And I was riding the recovery, and not going to lie, this recovery hasn't really seen much effects or much strength, but I still fundamentally believe in many of my picks, like Alibaba, Tencent, KWeb, TSMC. I think many of them are just experiencing short-term headwinds, and we are bound for a recovery. I just don't know when. So I don't really punt at the sidelines for a reopening or a government stimulus of some sort, etc., etc. I just buy when I think there's value, and time is my edge in the market. Which brings me to my next point. Market is not really stupid sometimes. More often times than not, you are the one that's stupid, not the market. So a company can be down 30%, 50%, 70%, 90%, and you can just sit on the sidelines and say that, hey, the market is being irrational. It's a greatest opportunity of your lifetime to buy into those companies. Not forgetting that, hey, some of you might really be right. Many of those good stocks out there, like, I don't know, Amazon, it's down 50%, Meta is down like 70%, and many of these big bulls of Meta, of Amazon, or even Tesla, they're saying that, oh, the market is irrational. The market is just discounting them wrongly. I think there's a reason why the market is ascribing that sort of valuation to those companies today. So if you think that you have done your homework, you think that the market is irrational, I think by all means, nobody is stopping you from deploying your capital in those names. Now, lesson number 8. I know many great investors out there say that catching the bottom is close to impossible. But I think I just wanted to make a pointer here, or maybe a side note here, saying that timing do matter. No matter how much we like to deny that, oh, we shouldn't time the market, you can't catch the bottom, yada, yada, yada. Especially if you're stock picking, timing do matter. If you entered Alibaba at the rock bottom, let's not say rock bottom, just say that you entered at $70. Compared to somebody like me that entered at 240 and I continuously averaged down like nobody's business. Alibaba hit a temporary bottom. I won't say that this is the bottom for Alibaba for now, but let's say you entered the position at like $70 odd, and now I have an average of 120, 140, 150. And if Alibaba is trading at 90 today, I'm still down at least a good 20 to 30%. But the other person, the newer investors that essentially catch the right timing for Alibaba, he is already up 20%. So I think just to erase the thought that, oh, since I can't time the market, I'm just going to buy today. But I think more than ever, I would just like to emphasize on the idea of having a good enough margin of safety. By margin of safety, sometimes people are looking at 20, 30%. So if you were to really want to swing hard, like really hard, deploying, I don't know, 30%, 40% of your portfolio, I think a margin of safety of more than 50%, 60%, 70% is needed. And back then, when Alibaba was trading like 50 something, I think that was a good enough margin of safety. And in retrospect, I honestly entered a little bit too early, even though I've been averaging down like crazy. So the perspective of, oh, I'm ready to average down, I think that's a wrong attitude to begin with. Yes, you need to be ready to average down. If you have done your homework, you think that the intrinsic value is a lot higher. But in future, I'm talking to the future Chiking that's going to watch this video. If you know that you are at the start of something, I don't know what thing it is in future, just be prepared that you're going to hold for a very, very long time. Now, lesson number 9, it revolves around this Chinese idiom. It's called 自欺欺人. So in English, it just means self-deception. So I think this particular problem is extremely prevalent in people that are probably intellectuals. So people that can do some sort of mental gymnastics with themselves. So the funny thing is, this idea of self-consolation or self-hypnosis or self-deception, it's important for human survival because sometimes it's needed to tell yourself a narrative and to tell yourself a story that your life is okay, it's not that bad. It's probably a survival mechanism. But I think this exact same mechanism is destroying people's investing career and how your mind thinks, especially in a bear market. Because I see it firsthand, myself included by the way, I'm not commenting on other investors. People tend to have the ability to turn any bad news into good news. And just so you know that one day, bad news will really just be bad news and no longer good news. So I'm not alluding to anything that is happening in real time today. Of course, I'm not talking about like bad job reports or unemployment figures where bad news turn into good news and good news turn into bad news and stuff like that. Of course, I'm not saying that, but I'm just saying from my own experience thus far, sometimes I do see myself committing to that flaw or that mistake. So just my own takeaway. And I think last but not least, just to end off this video, short and quick, lesson number 10, there is no right investing style, there is only one that suits you. So investing is always a self-actualization process, and I hope you get to the promised land soon. So with that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye guys!